It's nice to see all of you with us this morning, or perhaps I should say still with us. It's Friday, so you've survived almost to the end of the week. Now I know a lot of you are thinking, I can't believe it's over. I wish it would keep on going and going and going, but that's why you have to come back next year. Also, as I'm sure most of you guys know, the Mises Institute has another week-long summer conference, typically earlier in the summer, called the Rothbard Graduate Seminar, which is a more advanced, more technical discussion of economic theory. And it's really great for students who have already been through Mises University. So in the last year, we used Rothbard's Man, Economy, and State as the text, and basically just went through the entire book chapter by chapter, which is a lot of pages to digest in a week. In other years, we've gone through Mises' Human Action, chapter by chapter. So if you like what you've heard this week and you're interested in more, consider coming to the Rothbard Graduate Seminar. And I hope also you've had a chance, those of you who are interested in maybe applying for a Mises Institute Summer Fellowship, hope you've had a chance to talk to some of the current year Summer Fellows to find out what that's all about. We'd love to have some of you here for an extended visit next summer or a summer in the future. The subject this morning is the corporation, more specifically the corporation and the free market. This is an extremely interesting and important topic, not only for Austrian economists and libertarian scholars, but for all of us. Large entities, corporations in particular, large private entities, are so much a part of the landscape that we rarely take time to think about them or to analyze them. Just as a fish doesn't notice water, most of us don't notice Walmart, okay? Or if we do, we don't really think so much about why it is the way it is, or how might it be different, and so on. As you probably know, there are a lot of different kinds of business organization. Not only large firms, obviously small firms, corporations, and other types of organization as well. Large companies, corporations in particular, while they comprise only a small percent of the total number of firms. In the U.S., maybe something like 20% of all companies are organized as corporations, the rest being smaller proprietorships and so on. Yet corporations produce something like 80% of the goods and services. Okay, so the large firms tend to get a disproportionate share of the attention because they're the ones who are churning out most of the stuff that we consume, even though there are many, many more small firms. Right, just to get the discussion going, let me make sure that everybody's on the same page with terminology. Right, so really what we're talking about here is, if you like, kind of an extension or an add-on to the discussions we had earlier in the week on the theory of production and the theory of the firm. Right, so we talked about the production process. We talked about the means by which entrepreneurs take factors of production or inputs and transform them into consumer goods, outputs, final goods, right? And we talked a little bit about the firm as an organization. Why does production take place inside firms? What determines the boundaries of the firm? How should firms be organized internally, and so on? Here I want to add to that discussion by talking a little bit about the legal form of organization. The legal form of organization. So a firm of a given size and producing a given product or range of products, having a particular kind of management structure, can choose among a set of alternative legal forms, right? So, for example, a firm could be organized as a proprietorship or a sole proprietorship, meaning there's one owner, right? So a single entrepreneur, a single capitalist entrepreneur or entrepreneur promoter in Mises terminology, owns all the assets and operates the firm, runs the firm on a daily basis, okay? We sometimes think of a mom and pop store, okay, with mom and pop as the proprietors. I guess pop maybe is the owner and mom is his helper. A firm could also be organized as a partnership, right? A group of capitalist entrepreneurs pool their resources. Maybe mom and pop are equal owners of the mom and pop store. Or you think of a typical professional services firm, a law firm, an accounting firm, a small doctor's office with a series of owners 2, 3, 5, something like that, maybe 10, who again jointly own the assets of the firm from pooling their resources. Now, partnerships can, in principle, be large, right? Some of the big consulting firms, McKinsey and Company, and so on. Many of them are also organized as partnerships with many dozens or even hundreds of partners, right? But each partner has an equal stake in the ownership and an equal voice in the management of the entity. Now, other firms are organized as what we usually call them, we usually think of them as cooperatives. A more general term might be patron-owned companies, such as cooperatives. So, for example, one of the grocery stores where I shop in Columbia, Missouri, it's called Hy-Vee Grocery. It's an employee-owned company. And when you walk in, they have a big sign, proud to be an employee-owned company, meaning that the equity of the firm is owned by the workers. Okay, and it's not doled out equally. It depends on how long you've been with the firm and how senior your position is and so on as to how many ownership shares you have. You might imagine a firm that's owned by its customers. If any of you are from a rural area, particularly in the U.S., you might be familiar with the farmers co-op, right? So a small shop in which people can buy, farmers can buy their seeds and people can buy hardware and so on. Those, when you purchase from the co-op, or to be able to purchase seeds from the co-op, you have to join the co-op as a member. And sometimes there's just a nominal charge, but you become a part owner of the firm in your capacity as a patron, right? So the more stuff you buy from the firm, the more patronage shares or ownership shares you get. Other firms could be owned by their suppliers. Again, you see this quite often in commodity production, like ethanol, right? So a lot of ethanol plants are farmer-owned cooperatives, meaning that farmers in the area who, let's say they're corn farmers, right? They pool their resources and jointly set up an ethanol processing plant where the farmers sell their corn to the ethanol plant. Okay, so the suppliers of the ethanol plant are its owners. And the more corn they deliver to the ethanol plant, the more ownership shares they have. Okay, so all of these firms, what we normally call cooperatives, are different from proprietorships and partnerships in the sense that the owners are people who are otherwise patrons of the firm, who are its customers, its suppliers, or maybe its employees. Okay, that's to be distinguished from what we might call investor-owned companies. Right? Such as, for example, a limited liability company. So a limited liability company or a corporation is a kind of entity in which people who have no patronage relationship with the firm, who do not work in the firm, who are not intimately involved with the firm, yet can take an ownership stake just by buying some shares. Okay, so if I'm, starting up my own company to do X, Y, Z, I might sell ownership shares to the public. And anybody who wants to buy a share can become a part owner of my firm. In exchange for that, they get certain rights, right? They get a share of the revenues or the profits that are generated by the firm, dividends, right? So if I'm successful as a capitalist entrepreneur, if the firm is successful in generating profit, as we've talked about before, those profits are then divided up and passed out to the shareholders, so many cents or dollars per share. Okay, so being an owner in that sense gives you the rights to some of the firm's income, a share of the firm's income. It also gives you some voting rights. You can vote for the board of directors, you can vote for particular key decisions, maybe vote on management and so on. Okay? Now, these are called limited liability companies legally, right? Because part of the contractual arrangement between the firm and the shareholders is that the shareholders are only liable for mistakes that the firm makes up to the amount that they invested in the firm. Okay, we'll talk a little bit more about limited liability in just a moment. But these limited liability joint stock companies, most of them are publicly traded, meaning that the shares are listed in some secondary market. You can go to the New York Stock Exchange or whatever, and anybody can buy and sell shares of ownership in Microsoft or IBM or General Electric or whatever. But many limited liability companies are privately held, meaning only certain people can purchase the shares. The shares are not just offered to anybody, but only to certain people that the managers and current owners want to offer them to, what we call privately held firms, okay? So you could have limited liability companies could make their equity public, or they could keep it private equity firm. Now, a lot of economists, when they think about these kinds of issues, right, particularly if they are trained in the neoclassical perspective, in which the firm is really just characterized as a mathematical function, an equation explaining how many units of inputs it takes to get a certain number of units of output and so on, then all this stuff might seem completely arbitrary. I mean, these are just legal distinctions. This is something for lawyers to work out. It makes a difference on paper, but it doesn't have anything to do with the actual operations of the firm. It's not an economic issue, right? Now, it is indeed true that there are important legal differences among these forms, right? They're often different tax. They're taxed at different rates. The income is taxed in different ways. There are different kinds of regulations, right? So if a firm is a publicly traded limited liability company, it has to reveal certain information to the government. It has to file quarterly earnings reports in most countries. The theory is this is to make sure that information that would be valuable to investors is sort of commonly available to everyone. Privately held limited liability companies, partnerships, proprietorships, and so on, are not required to disclose that information. Okay? I mean, that could be important. There could be kind of strategic reasons why a firm would prefer to keep information private and not disclose it to the market, right? I mean, in disclosing that information to potential investors, you're also, of course, disclosing it to your competitors and to other people who might want to come into your market and so on. You might prefer to keep that private. And just as an aside, when the Sarbanes-Oxley bill was passed a few years back, one of its features was it imposed stricter reporting requirements. The companies had to disclose more things. Publicly listed companies had to disclose more things. And the officers of the company, the CEO and so on, had to sign, put their personal signatures on the financial statements, and they could get in huge trouble if any errors were found in the financial statements. One consequence of that is that a lot of firms that were previously publicly traded companies went private. They delisted themselves. They took themselves off the stock exchange because they said, we don't want to deal with that. Right? Or newer companies, smaller companies that were privately held and thinking about going public said, we don't want to have to meet those disclosure requirements. So in a sense, that part of Sarbanes-Oxley increased the cost of being a listed company, a publicly listed company. That's a real cost, right? That's money out of the firm's pockets. But aside from these kind of regulatory issues, there are also important organizational and financial differences among these types of firms, among these different legal forms, right? Remember, as we talked about earlier in the week, ownership of productive assets is not just kind of a thing that exists on paper and maybe you get some little income stream. It also gives you decision rights. Okay, owners have decision rights over the uses of assets. Remember we talked about particularly under conditions of uncertainty, when situations arise that are not covered in some kind of a formal contract or agreement, somebody has to make decisions about how those resources will be used. And that is part of, that's part of the owner's rights as an owner, right? Ownership gives you the right to make decisions about how resources will be used under conditions not covered by prior agreement. So how the ownership of the assets is divided up affects real decision making. Okay? It affects incentives, for example. So a manager of a firm who is also the owner, the proprietor of a mom and pop, has different incentives than a manager of a firm that's a publicly traded corporation where the manager doesn't own any equity himself. Okay, so it could be important incentive differences. We'll talk about those in more detail in just a moment. Also, sort of governance questions, right? In a partnership, big decisions have to be made through a vote. Okay, suppose you have 2 or 3 partners in a dentist's office, and they have to decide whether to move into a new building or keep the old building. The partners have to vote on it, and maybe they disagree. Maybe they argue. Okay? At the same time, if a firm is, with General Electric, shareholders vote on things, but the voting is a very different process because you have thousands of owners. They vote in a much more decentralized, anonymous fashion. And many decisions they simply delegate to the board of directors and to the top management without any votes. Okay? So you can see there could be important differences in how things operate and how the firm actually makes its investment and production decisions based on who owns it, right? Another important difference is the cost of capital. Differences in the cost of capital. And this is pretty obvious once you think about the corporation, right? The big advantage of the publicly traded corporation is that you can raise a lot of money really fast. Okay? The ethanol plant, if it wants to raise money, if it wants to increase its capital, it has to find new farmers who will sell to it and thus become owners. Right? A partnership, if you want to have more capital to expand your operations, either the partners have to kick in more or you have to get a new partner. Okay, a proprietorship is limited by the resources that the proprietor has or can borrow. Okay, whereas with a joint stock company, a publicly traded corporation, all I got to do is offer a few more shares to the public and people will buy them up. I can raise a lot of capital really quickly. Now that has both pros and cons. Right, but you can see that as a potential difference in the sort of economic benefits and costs of these different forms. And that's the only point I'm making right now, is that this is not just merely an arbitrary legal distinction, but there are real economic differences in how a firm is organized and governed. Now, I want to detour for just a moment to talk about limited liability, because this is a big issue that comes up in our little circles, particularly in recent years. There is kind of a strand of thought within libertarian circles arguing that the corporation in particular is a kind of specially privileged or even illegitimate form of organization. It's been argued that the only reason we have so many corporations today, the only reason corporations are so large and powerful is because essentially they get this special legal privilege granted to them by the state, that limited liability is not a kind of a natural organic feature of the market, but is a special monopoly privilege, a special legal right that's granted by the state. Of course, what we mean by limited liability, right, is that if I'm a shareholder of IBM, and let's say IBM goes bankrupt, okay, and IBM owes money to the bank and can't pay it back, how much money can the bank get out of me as a shareholder? Right? So limited liability in the sense of credit or debt, right, means that shareholders are only liable for the debts of the corporation up to the amount they invested in it. Okay, so the value of my shares in IBM can go to zero, but the creditors of IBM, if it goes bankrupt, they can't come after me personally. They can't try to take my house, my car, my personal savings account, and so on. I'm shielded. My personal assets are shielded from the creditors of the corporation. I'm only responsible up to the amount I invested in the corporation. Right? With a proprietorship, a sole proprietorship, if it goes bankrupt, creditors can go after the personal assets of the proprietor. Same thing with partnerships. Okay? So owners of a corporation are legally protected from certain kinds of liability. Now, again, some people, my good friend Roderick Long is one of them, have argued that this is illegitimate and that this is an artificial privilege that's been granted by the state. And in a pure free market society, we wouldn't have limited liability. Therefore, we probably wouldn't have as many large corporations, that we would have more smaller firms, more proprietorships, more cooperatives, and so on. Firms would be local, smaller, less hierarchical, and so on. Now, I should start just by mentioning, as a historical fact, I think that the libertarian critics of the corporation, do not quite have the history right. Namely, limited liability is, if you look at the historical record, has been a part of most common law systems long before there was any formal recognition of it by the king or by Parliament. So it isn't the case that there was no limited liability and then all of a sudden the king issued a royal decree by waving his king wand, and then all of a sudden there was limited liability. There's always been some kind of limited liability ever since the emergence of the joint stock company in the sort of, late medieval, early modern period. The other thing to keep in mind is there are two different kinds of limited liability. Okay, there's limited liability for debts, what we just talked about, but also limited liability for torts, for criminal actions, or, for damage to person and property that is committed by the corporation. Okay? So, if you think about it, the issue of limited liability for debts is that's not really a libertarian issue. Right? Because you could imagine that the conditions under which creditors can try to get assets of the owners of the firm is something that could be negotiated contractually whenever the firm goes to borrow money. Right? So imagine two different corporations, right? One of them says, hey, we are a limited liability company. So we go to the bank and we ask for a loan and we say, hey, when we sign the loan contract, we want to put in the contract that if we can't pay it back, you cannot come after the personal assets of our shareholders. And the bank might say, oh, I don't know, that didn't sound too good. You guys don't have very much collateral. No, I won't give you the loan. Okay, fine. Or they might say, okay, we'll give you the loan, but we want a pretty high interest rate, and we want all these other provisions. Okay, here's another company over here that goes to the bank and says, hey, we'll put in the contract, we're so confident in our abilities, we'll put in the contract that if we go bankrupt, you can come after us any way you want. And the bank might say, ooh, we like you better. Okay. So yes, we'll lend you more money or we'll give you a lower interest rate or whatever. In other words, from the firm's point of view, the question of whether or not to include limited liability or some kind of shareholder shielding in the debt contract is just a question of balancing benefits and costs. I mean, it increases your cost of capital to put that in the contract, but it also protects your equity holders. Is it worth it? Well, this is something that borrowers and lenders would just work out on a case-by-case basis. So the point is you don't need any government edict to have limited liability with debts. That's something that the market participants can negotiate any way they like. The more complicated issue is limited liability for torts. Limited liability for torts. Okay, so suppose that Eric here is my employee, right? And I'm a manufacturer, or I'm the owner, I'm shareholder of IBM, let's say, and IBM has these delivery trucks where it delivers computers out to the retailer or something like that, and I hire him as a truck driver. And he's driving an IBM truck, and he's taking a truckload of IBM computers out to the retailer, and, he drives too fast, and he crashes into Michael's car and smashes it. Who has to pay for Michael's car? Okay. Now, if it's in a case like that, probably IBM would write a check. But what if it's what if he causes injury to Michael? Does Eric go to jail? Or am I, as the owner of the company, as his employer, am I legally liable for the person or property damage that he's committed? You think I'm just making this up? Think about the BP oil spill. Okay? BP has a lot of cash, right? So assuming that it has to pay out bazillions of dollars, to Obama and to all these, there's all these hundreds of lawsuits that have already been filed, Suppose that so many legal verdicts are rendered against BP that it spends all its cash. And even if it's sold off all of its oil, all of its assets, all of its inventory, there still wouldn't be enough money left over to pay all these lawsuits. What happens then? Right? So if there is no limited liability in the tort sense, then, Michael or whoever's suing BP could sue the shareholders personally and go after the shareholders' houses and cars and savings accounts, etc. Right? Under current law, they wouldn't be able to do that, right? They can try to get as much money as they want out of BP, but they can't go after the personal assets of BP's owners, its shareholders. Again, this is not a contractually negotiated thing. It's BP caused harm. It damaged somebody's property. It injured someone. It killed someone. Okay? So, critics of the corporation, critics from the libertarian side, say the state has decreed that corporations are not liable for torts committed by their employees. That's not right. That's not fair. That's a special privilege. That gives corporations an advantage in raising capital and so on. That's why we have so many of them. That's why they're so big. Okay? I personally am not convinced by that argument. Okay, and there are two reasons for that. Something that Murray Rothbard wrote once, he thought about this a little bit, and he said, I'm kind of suspicious of limited liability, that maybe that isn't legitimate in a libertarian society, but I don't know how important that is empirically. In other words, even if the argument were true that limited liability for torts is a kind of illegitimate state grant, it might also just quantitatively not be a big deal. In other words, we might have large corporations for reasons having nothing to do with that, just because it lowers the cost of capital or provides other advantages or whatever. Okay, so showing that limited liability for torts is illegitimate, it doesn't follow from that that's the reason why we have so many large corporations. We might have them anyway. But it's not even clear to me that tort limited liability is illegitimate. Okay, there's an assumption that I think is made by the critics that in a pure free market society we wouldn't have that. Well, it's not quite clear that that's the case. Right? The general legal issue here is what the lawyers call respondeat superior in Latin, or vicarious liability in English is a kind of vicarious liability, which means when is person A responsible for something that person B did? Okay? So if I'm the commander of the army and I tell Eric, go over here and shoot Jonathan, now, Eric may not be absolved of all responsibility, but you can see that his commanding officer might bear some responsibility for that, morally, ethically, and even legally, in a war crimes tribunal. Okay? At the same time, it doesn't follow that everything that Jonathan does is Eric's responsibility. Right? If Jonathan goes off on his own and does things that are not specifically commanded by Eric, or are not within some narrowly defined scope of responsibilities as granted by Eric, is that doesn't get Jonathan off the hook. The famous Nuremberg defense, right? I was just following orders does not excuse you legally for every action that you might take in wartime, committing war crimes and so on. Right? Likewise, go back to the example of Eric driving the truck. Right? Forget about the corporation per se. Okay, suppose that my computer shop is a proprietorship. I'm the sole owner of a proprietorship. I hire Eric. Eric's my employee. I tell him to drive the truck. He smashes into Michael, wrecks Michael's car. Should I legally be responsible for paying the damages? Or should Eric have to figure that out on his own? Well, common law courts have worked this out in different ways, right? But normally they have in mind some notion that, look, was Eric within the scope of his duties as required by the employment contract when he crashed into Michael? Okay, did I instruct Eric when I hired him, drive as fast as you can, and please, send me some text messages while you're driving? Okay, then you might say, yeah, I'm responsible. But if I said, look, deliver these computers, and presumably within the normal rules of safe driving, and he drove like a maniac and hit him, then I could argue in court, hey, he wasn't acting in his capacity as an employee when he did those things. Therefore, I'm not responsible for the actions that he committed. Right? So even in BP's case, right, if it could be shown that particular employees of BP, some of you may have been following this, there's all these claims that some of the managers on that rig turned off the alarm system that would have warned them about certain things building up under the surface or whatever. If they did that on their own, without, not acting under the authority narrowly granted of their superiors, then it's not clear why BP shareholders should be responsible. In other words, the point is this is not really about corporations and limited liability per se. It's a more general issue of when owners are responsible for actions of subordinates. And most legal theorists would say owners are not always responsible for actions of their subordinates. So the point is, even if the government, even if the king, even if state legislatures had never granted limited liability to any corporations through any statutes, my conjecture is that shareholders would typically not be found liable for torts committed by their employees, with the exception of special cases where the employees were, narrowly following orders. Okay? Well, one example that some of you remember, I guess it was Domino's Pizza. Was it Domino's or Pizza Hut? Used to say, you get it in 20 minutes or less, or your pizza's free. And they dropped that policy because of litigation. Right? Because people were suing, I can't remember if it was Domino's or Pizza Hut. Does anybody remember? No. People were suing Domino's saying, well, your driver hit me, but they were driving recklessly because you had told them they have to make it there in 20 minutes or the pizza's free. Okay. So you could argue in that case, the driver could say, well, I had to drive recklessly because it's company policy that I got to get the thing there fast. Right? But with the exception of cases like that, I don't think that shareholders would be found liable for torts committed by employees, even in the absence of any kind of state grant. Right? There's, by the way, a subordinate issue is what's called legal personhood. I think that's kind of a red herring too. That some people have argued that legal personhood status means the law treats the corporation as an individual for certain purposes. Meaning corporations can write contracts, corporations can sue and be sued as if they were individuals, though they're obviously kind of artificial legal persons. I don't think that's a particular advantage that the state grants to the corporation, as opposed to other kinds of organizational forms. So I don't really think that's an issue here. The bottom line is, it's not at all clear to me. I'm not at all convinced that the corporate form of organization is somehow the beneficiary of special government privilege. Okay? Let me talk about some specific issues with the ownership and governance of corporations. The issue that has been talked about the most over the years, received lots and lots of attention, is what's called the separation of ownership and control. The separation of ownership and control. It's sometimes called the Burley and Means problem, named after two famous writers who published a book in the 1930s, 1932, called The Modern Corporation and Private Property. Adolph A. Burley and Gardner C. Means. There's a picture of Mr. Burley. Burley was a law professor. Means was a kind of New Deal bureaucrat. Both of these guys were very close to Franklin Roosevelt, were important players in the Roosevelt administration. And they wrote a book arguing that large corporations were economically inefficient. Economically inefficient because, they argued, shareholders are so remotely involved with the day-to-day operations of the firm that managers of the firm can get away with anything. Managers of the firm can get away with anything. They said, look, these laissez-faire economists, Adam Smith or whatever, argued that the free market was good for consumers because companies have to obey the dictates of the consumers, so to speak, right? You have to produce the goods and services that consumers want in a way that's most economically efficient to make profits. Otherwise, you'll make losses, you'll go out of business. You know the story. Burley and Means said, well, maybe that was true in the old days when we had small proprietorships that were very responsive to customer demands and so on. But they said, it's not like that today. In the modern economy, 20th century economy, most production does not take place in those kind of firms. Rather, it takes place in these big impersonal corporations. And the owners of these corporations are shareholders. The people who manage these corporations on a day-to-day basis are, the CEO, vice presidents, corporate staff, top managers, and so on. In other words, the owners don't exercise much control over what the firm does on a day-to-day basis. So even, they argued, even if owners, would like the firm to maximize its profits, and to do that it has to satisfy customers, they said that's not how it works in a big company. The managers basically do whatever they want. Or rather, the managers have a lot of opportunity to run the firm for their own benefit. Bigger offices for the executives. Right? Lots of bonuses and perks, company cars, corporate jets, big salaries, a big staff, right? Maybe the firm engages in a lot of mergers and acquisitions because, every captain wants to be captain of a bigger ship. And so the CEO is kind of on a power trip and wants to command a big empire and starts buying up a lot of other companies. Not because it's economically efficient, not because it adds to profit, but just because it benefits the top managers. It adds to the top it gives them utility. Okay, so according to Burley and Means, with the separation of ownership and control that characterizes the corporation, we can no longer assume that firms maximize profit, and that therefore we can no longer assume that the capitalist system is efficient. Okay? Now, what can we say in response to this challenge by Burley and Means? Well, let me begin just with the caveat, is something that I mentioned on Monday or Tuesday, that really what we're talking about here is a problem of delegation. In other words, the owners of IBM or Microsoft or whatever have delegated their day-to-day control rights to the managers. In other words, if I buy 10 shares of IBM, there are thousands of shares, millions of shares outstanding. I know that buying 10 shares of IBM gives me 0.0000001% of the total equity of IBM. So it's not like I'm going to march into the shareholders meeting and state my demands. I want the firm run this way. The CEO is just going to call security and have me thrown out. Okay. But I recognize that. I realize that by buying a few shares of a publicly traded corporation, I'm not really going to be able to influence the day-to-day management of the firm. Okay. You say, well, if I don't like that, what can I do? Don't buy them, right? Sell the shares, right? No one is compelling me to buy those shares. So the equity holders in a publicly traded corporation, as it were, have voluntarily delegated day-to-day control to the hired managers. Right? I'm only making kind of the logical point that if you delegate authority to someone, you can take it back. Okay, so if I hire Eric to be my driver, maybe I say, look, Eric, I'm not going to tell you how to get from Auburn to Birmingham. You figure out the most direct route, and if you feel like it's better to stop a few times to take a bathroom break or to have some coffee, if you think that's going to make you a more effective driver and add to my bottom line, fine. I'm not going to micromanage that. You do it how you want. Now, does that mean that Eric is now running the show on his own and that I'm just kind of a helpless, little owner and he's taking advantage of me by doing whatever he wants? No, I hired him. I chose to hire him and not somebody else. I chose to delegate certain decisions to him, but that was my choice, right? And I could change my mind, right? I could fire him, or I could say, Eric, this is not working out. Okay, I'm putting a GPS tracker, in your truck. I'm putting a chip in your skull. I want to know exactly where you are at every moment and what you're doing. Okay? So the point is, the fact that an owner delegates authority to a subordinate does not mean the owner doesn't have authority. That's that's your choice, right? In the words of the famous Canadian philosopher Neil Peart, who wrote the lyrics for the band Rush, if you choose not to decide, you still have made a choice. Okay? So my point is, the owners of the corporation are, in a sense, voluntarily delegating authority to managers. There's nothing sort of a priori illegitimate about that. Now, it might still be inefficient. That might be not a very good way to do things. So let's just look at the positive arguments on, how big a problem is separation of ownership and control. Is it a big deal or not? Does it really matter? Okay? Well, people have given a lot of thought to this Burley and Means critique over many decades. And those of you who have taken advanced microeconomic theory or whatever may recognize this as an early statement of what we now call the principal-agent problem. So-called principal-agent problem, where the shareholders acting as the principal are, there's a potential efficiency loss or efficiency problem from the fact that the managers of the corporation, the agents in principal agent theory, have a lot of discretion or autonomy about what they're going to do. The principals have a difficulty monitoring the agents very closely on a day-to-day basis. So, as scholars have thought about principal agent problems in corporations and other large organizations, they've come to realize that, well, it is certainly true that the managers of a corporation, that the executives of a corporation do have some discretion, right? I mean, of course it's true that the shareholders of IBM are not looking over the CEO's shoulder every minute of every day telling the CEO what to do. The CEO does have some discretion that has been delegated by managers. But how much discretion? Or to put it another way, are there some features, some mechanisms, some institutional arrangements that constrain the discretion of managers? And the answer is yes. Corporations have set up, or if you like, over the years, corporations have evolved a number of control mechanisms that, while not eliminating managerial discretion entirely, place severe limits on it. Mechanisms or institutions that constrain managerial discretion. And it's useful to separate them into internal and external. Internal meaning inside the firm, external meaning outside the firm. Okay? By internal control mechanisms, we mean things like setting up a board of directors. Okay, so the shareholders can designate a kind of intermediary. They can say, well, look, we're not going to monitor the managers every day, but we're going to vote for a board of maybe 10 people or 20 people of experts, specialists, experienced managers and famous people and so on who will have the task of monitoring the managers pretty closely. So the board of directors might meet, every quarter and supervise the managers and go through the financial statements and review decisions made by managers. Okay? Shareholders can vote, right? I mean, sometimes you have what's called a proxy contest where a particular issue that has to do with the operation of the firm might come up to a full shareholder vote. Is the firm going to go this direction or that direction? Is it going to adopt this strategy or that strategy? Let's let all of the shareholders vote. They call it a proxy contest because most of the shareholders don't show up in person for the annual shareholders meeting, but rather they vote by mail or on the computer. They can send in their vote by proxy. Okay, so you do have some voting over key decisions. Now, obviously, that's not going to be an effective way of dealing with every decision that comes up day to day, but it can be useful for some large ones. The owners of the corporation can also instruct, through the board, can instruct the managers or can have the managers' compensation be based on performance. Okay? So the owners can rely on performance-based pay to help align the owners of the managers with with their own interests, the interests of owners. Right? So assume, for example, that the owners want the managers to work hard and maximize profits, earn the highest, the most profits, to increase the stock market value of the firm and make money for the shareholders. But the managers would rather goof off. They would rather play golf 3 times a week and, just sort of sit around and shoot the breeze or whatever. Okay? Now so one thing the shareholders can do is they can say to the managers, okay, look, you get a salary, but then you get a bonus every year or every quarter or whatever based on the profitability of the firm. If firm profits are high or if you meet a certain profit target, you get extra money in your pocket. Or you could do it more directly by saying to the managers, we're going to issue you some shares of stock. Part of your compensation will not be cash, it'll be stock. Or maybe stock options, right? We give you the right to purchase a certain number of shares of stock at a certain price, such that the managers are better off when the stock price is high. Okay, so the manager, he likes to play golf and goof off, but he also likes money, and he wants to get the bonus, so he's going to work harder than he otherwise would to hit that performance target, right? Or if he himself or herself owns shares or has stock options, the manager is going to work harder than otherwise to try to get the stock price high. Okay, so that's one way that owners can try to align managers' interests with those of the owners, right? There's also what you might call the sort of internal market for managers itself. The internal market for managers itself. There's a famous article by Chicago economist named Fama. I heard Murphy denouncing him yesterday in another class in another context. This is the same guy, but a different article. Fama pointed out that there's a lot of turnover within large companies, and many times the career path, the promotion path, it has to do with sort of rising up through the ranks. I like to think of this as kind of the Italian mafia version of corporate governance. Okay, with apologies to any ethnic Italians in the room. If you think of, you remember the guy back in the 80s and 90s, John Gotti, the famous New York mobster? They called him the Teflon Don because none of the charges against him would ever stick, although eventually they got him. He was head of one of the large New York crime families, the Gambino family. Now, if you know anything about the mafia, meaning if you've watched a lot of TV, you know that the way you get to be head of a mafia family is typically how? Yeah, you kill the guy who was the head before you, okay? So John Gotti was like a lieutenant. He was like, a subordinate to the previous head of the Gambino family, and John Gotti whacked him. And then he became the head of the Gambino family. Now, I mean, think about it. You can't just arbitrarily go around whacking the boss, right? But the fact that John Gotti was able to get away with this suggests that maybe the rest of the mafia leadership was not too happy with the old boss, and they were willing to put their lot in with Gotti and so on. The point is, if you're the CEO of a large corporation, and you're playing golf, and you're wasting time, and you're a bad manager, for whatever reason, you're not acting in the interest of shareholders, there's a vice president out there somewhere. There are other managers in the firm who are watching you very closely, thinking, hey, I could be the CEO, right? And who therefore have an incentive to publicize, to report, to go to the board of directors and report, to say to the shareholders, hey, look, the current CEO is not doing a great job. I could do better. Kick out that person and put me in charge, okay? In other words, people, part of the principal agent argument is that the shareholders don't have a lot of information about what's going on in the firm because they're far removed from it, right? But remember, there are other people who do have that information, namely other managers who have an incentive to keep the CEO on the straight and narrow, okay? Now, all of these mechanisms can be effective at limiting managerial discretion, but an even more effective set of mechanisms is what we might call external control mechanisms. And by the way, if you're having trouble seeing in the back, the slides are already up on the Mises Academy page. If you want to, you can look at them later. What I mean is there is pressure or there are constraints that come from outside the firm. Simplest case would be competition in the product market. Okay, so if this is IBM, whatever. I mean, IBM is producing computers and it's competing with other companies that produce computers. And if the managers, are such slackers that they don't, manage the firm well at all, and the firm starts producing bad products and consumers don't want to buy them, the profitability of the firm falls, maybe eventually it'll go bankrupt, and then the CEO will be out of his cushy job. Okay, so there is some limit, there's some upper bound on how much discretion managers can engage in when they're, competing against rivals who may have less, whose managers may not be slackers. Okay, so that external competition in the product market is a constraint. You can also have discipline from suppliers of capital. Discipline from suppliers of capital. Now you might be thinking, but we just said the suppliers of capital from a corporation are shareholders who are far removed from the day-to-day operations and don't know what's going on and so on. How can they exercise discipline? Well, in a publicly traded corporation, it's not the equity holders that do this, but you could also have other capital suppliers, creditors, or large institutional investors like pension funds that may be in a position to exercise some control. Okay, so if you have a lot of money, if you've borrowed a lot of money from the bank can come in and chew you out and say, look, we want the managers to do X, Y, Z. Otherwise, we're going to call the loan or we're not going to renew the loan or whatever. Some of your shareholders might pool their resources and invest as a block. Again, like a mutual fund or a pension fund. And in fact, some of the most influential institutional investors are things like the California State Employees Pension Fund, which has tens of thousands or hundreds of thousands of members, but it kind of acts with one voice. If the manager of this big California pension fund, calls the CEO of IBM and says, "Hey, we're not real happy about what you guys are doing," you can be sure that IBM, the CEO, will take that call, okay? Because he doesn't want the pension fund to pull all of its assets out. That might represent a big chunk of IBM's equity, okay? By the way, in some countries, institutions like banks can not only lend money to the firm, but can also own equity themselves. In the U.S., this is not going back to the Glass-Steagall Act in the 1930s, so-called separation of commercial banking from investment banking. Commercial banks cannot own equities of corporations. But in other countries, like in Germany, for example, most of the large corporations in Germany are majority owned or have big ownership, are to some degree owned by banks. So big German banks own huge chunks of equity of large German firms, and you can bet that these large banks exercise do a lot of monitoring and governance of the managers of those firms. Okay, probably the most effective mechanism, particularly in a system like the U.S. system, is what Henry Manne, a scholar who wrote a famous article in the 1960s called "The Market for Corporate Control." So Henry Manne, M-A-N-N-E, wrote a famous article in 1965 called "Mergers and the Market for Corporate Control." And his argument is very straightforward and extremely powerful. The argument he offered was this. He said, go back to our example, say it's IBM, where the managers are playing golf and goofing off and not doing a good job. Okay? As information, so let's assume that because of this, the products that IBM produces are not as good as they otherwise would be. The computers aren't as good, or the software is not as good, whatever. Customers start, buying other products instead. The profitability of IBM falls. What's that going to do in the stock market to the stock price of IBM? It's going to go down, right? I mean, the stock price is driven by, investors' expectations about the current and expected future profitability of the firm. My willingness to buy a share of stock of IBM depends on how profitable I believe IBM will be in the future, how much dividends, how much I'll earn in dividends, and how much I might be able to realize in capital gains and so on. So if the managers are doing a bad job, the stock price of the firm is going to fall. Why do the managers care? Well, if they own stock, they might care. But there's another even more important reason why they might care. Right? If the stock market, if the stock value of the firm is falling, the stock price of the firm is falling, I mean, think about it. What kind of signal does that communicate to other participants in the market? Well, it says to other market participants, look, this is a firm that, it has a good brand name. It used to produce decent products. The stock price is really falling. Probably this is a badly managed firm. If we could somehow fix it up, maybe we could get the stock price to go up again. In other words, imagine, say, another firm, Dell Computer or something, is sitting out there thinking, wow, the price of IBM is falling. Something's wrong at IBM. Let me go check it out. Well, they seem to have decent products. What if we were to acquire IBM? What if we merged with IBM? Then we could replace those bad managers and we could get the thing fixed up, and we'd end up with an asset that's worth more than what we paid for it. Okay? Or you could be a so-called corporate raider. Michael Milken or the Gordon Gekko character from Wall Street, right, that engages in so-called hostile takeovers. Right? Now, I always think one of the funny things about these corporate control transactions is the way they're portrayed in the media. Right? So the media uses this kind of military language, like a raider. A raider is like a buccaneer, like a captain of a pirate ship who has swords and guns and steals stuff from you. They talk about someone who comes to your rescue, another firm that offers to buy you out instead to keep the raider away is called a white knight, like somebody on horseback. I like this cartoon. It's one of these old Sidney Harris cartoons from the New Yorker. The secretary says, "An investment group from Tokyo is here." To me, it looks like a hostile takeover bid. Okay, what they mean by hostile? A hostile takeover simply means a takeover in which the incumbent managers don't want to be taken over. Okay, So a so-called raider, a buyout specialist, who is that? Well, that's an entrepreneur, right? Who says, look, IBM isn't doing so well. I'm going to raise a lot of money, typically by borrowing, by selling high-risk, high-yield bonds, which the media calls junk bonds. They're simply high-risk, high-yield bonds. Raise a lot of cash by selling these bonds, and then buy out all the equity of the firm. I go to the current shareholders of IBM and say, okay, currently IBM is trading at $10 a share. I'll give you 15 if you'll give to me or tender your shares to me today. So that's called a tender offer, right? And if a majority of the shareholders agree, then the raider now has majority ownership of the firm and can kick out the managers and replace them with better managers, right? Presumably the raider is only doing this because he believes that once he reorganizes the firm, then he can eventually make it more valuable and he can sell it off again. He can resell it to the public in an initial public offering, an IPO, at a higher price than what he paid. It's just like, fixer-upper houses. People who buy rundown houses and fix them up and then sell them and try to make money from doing so. That's exactly what a takeover specialist, that's exactly what a corporate raider is. It's a kind of entrepreneur, right? Because naturally there's uncertainty involved. Right, so you see the mechanism here. If I'm a manager, I don't want the share price of the firm to fall too much because that invites takeover or merger. Right? That's a signal to a raider or to another firm that I'm doing something wrong. Also, of course, at a lower stock price, it's cheaper for another firm or for a raider to buy out the assets of the firm in question. So it's in the manager's interest to keep the stock price high so they won't lose their jobs. Okay? That's the basic mechanism that was explained by Henry Manny. Curiously, there's an interesting passage from Mises, and I'll stop here because we're running out of time. From Human Action, where he expresses basically the same idea that's in Manny's article on the market for corporate control without going into detail about the specific mechanism. There's an interesting passage. Mises says the following. He says, the Burlean means doctrine, this problem of the separation of ownership and control, he doesn't name it, but it's obvious that's what he's talking about, disregards entirely the role that the capital and money market, the stock and bond exchange, which a pertinent idiom simply calls the market, plays in the direction of corporate business. Now here's the key passage. Here's the money quote. Mises says, the changes in the prices of common and preferred stock and of corporate bonds are the means applied by the capitalists for the supreme control of the flow of capital. The price structure as determined by speculations on capital and money markets, on the big commodity exchanges, not only decides how much capital is available for the conduct of each corporation's business, it creates a state of affairs to which the managers must adjust their operations in detail. So the action of these money market participants, stock market participants, speculators, investors, people who buy and sell stock, corporate raiders, LBO specialists, and so on, their actions not only decide how much capital is available to each branch of industry, to each firm, they also create a set of conditions to which the managers must adjust their operations in detail. In other words, according to Mises, it isn't the managers who run the economy. It isn't the managers who are captains of the ship in capitalism. It's financial market participants. It's the shareholders, the bondholders, the speculators, the money traders, the raiders, and so on. And you might remember I mentioned, when we're talking about theory of the firm, if you look up this passage in Human Action, it's in the context as Mises is talking about socialism. And he's pointing out that what the socialists never realized is that what makes an advanced industrial economy work is not the decisions of the plant managers, but rather the fundamental decision of allocating capital resources to various activities. For that, you need a private, free market. You need private stock markets. The most important market in a capitalist economy, in other words, according to Mises, is not the product market or the labor market or the market for land or the market for raw materials, though those are indeed important. The most important market is the stock market. That's where the ultimate decisions about resource allocation are made. Okay? It's 10 o'clock, so let's stop. I had another couple of slides that are extremely interesting and important, but in the interest of time, we'll skip them.